Hi everybody, my name's Griffin Bridgers. This is part 18 of the basics of generation skipping transfer tax. Today we're going to really take just a surface level view, and I'll emphasize why in a minute, on allocating GST exemption at death. Now before we get started, I want to remind you again, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. So, to give you the lay of the land, really most of this series so far has focused on a transferor's lifetime allocations of GST exemption. However, it could be the case that when a transferor dies, they have some GST exemption remaining left over. So you need to know what to do with it, and the rules around what to do with it seem very simple when you read them, but actually become much more complex when you see how they interact with all of the code provisions and regulations that deal with the GST tax. Now, originally I'd envisioned this as being about preparing Form 706, but there's much more depth to that subject and to the strategies around the allocations you can make on Form 706. So this is going to be more about the basic question of whether you should file the 706, what happens if you don't, and even strategies potentially on a surface level around filing a final Form 709. So the big picture is looking at an individual's GST exemption. Much like a gift and estate tax are interactive and kind of look at cumulative lifetime transfers that are reconciled at death. We have the same approach when we look at an individual's GST exemption. If we read Code Section 2632A, what it says is that you can allocate your GST exemption at any time, either you or your executor can do so, up and until the due date with extensions for your estate tax return, even if one is not required to be filed. And what we'll find out is that creates kind of a final deadline after which there is a final set of automatic allocation rules that kick in. So the big picture is that any time before that, you have the ability to manually allocate GST exemption or rely on automatic allocation rules to elect out of those and really have control of that process. It's more that your control goes away the minute that deadline for the 706 plus extensions passes, even if your estate isn't required to file it. So a lot of what we're looking at is going to be around the question of should we file and what are the different permutations under the automatic allocation rules at death, which are a little bit different, and even the terms of a trust that could come into play. Now, to start, you have to know how much GST exemption you have to have left before you even dive into the rules. So this really looks through the history of all of your prior lifetime transfers by gift, where there could have been automatic or even manual allocation of GST exemption. Now, there's no hard and fast rule. There's some things I want to note here. One, if you'd had crummy rights under trust, remember that those have different rules to qualify for the GST tax annual exclusion than crummy rights do to qualify for the gift tax annual exclusion. So because of that, there may have been automatic allocation to crummy rights even if you did not intend that, or even if the decedent did not intend or expect that, which means you could have had under allocation if you elected out, or automatic allocation may have forced more GST exemption to apply than you thought. You may also have situations where there's been over-allocation of GST exemption as well. Now, there's a fear that GST exemption could be wasted then, but this is an important point that's often lost in the regulations. And if you remember nothing else in this course, remember this point that GST exemption, except for a charitable lead annuity trust like we looked at in the last part, is never wasted. I want to direct you to the latter sentences in Treasury Regulation 26.2632-1B4, which really have the spirit of voiding any GST exemption during life that's in excess of what is needed to create a zero inclusion ratio. So because of that, if there was over-allocation, even though the allocation is irrevocable, there is a voiding of excess allocation that could increase the amount of exemption available at death. So As I mentioned, we have a final countdown. Once they transfer or dies, a clock starts ticking that's going to end when the estate tax return is due. And at the due date, if there hasn't been a 706 already filed, including extensions, then automatic allocation rules kick in for any property that wasn't subject to a GST transfer during the decedent's life. However, we may have to look at, too, any gifts made during the final year of life, because those are going to require their own gift tax return potentially, and their own gift tax return reporting. For any transfers in the final year of life, you have to look at the automatic versus manual allocation rules first. And then we start the countdown to either file a 706 and manually allocate GST exemption, or not file a 706 or a 709 if one is not required, and to rely then on the automatic allocation rules. So when we look at this overall ordering, there's a certain hierarchy at death to transfers. And this is what kicks in as a default if you don't file a 706. First, you look at direct skips and you fill those up, and then next you go to all other property which is transferred in a way where there might be a taxable termination or taxable distribution in the future. So even though the term indirect skip isn't used for allocations at death, it still kind of has a similar definition. That's why I say on number 2, we look at all transfers that are indirect skip-like from property that's both in and out of the gross estate. And we'll see why in a minute. So these are pretty straightforward, but there's some nuances in each category which, depending on the depth of the rabbit hole, may be a little bit beyond the scope of what we can discuss today. But first, remember that when we're looking at these allocations, whether automatic or manual, you first have to net out, one, any estate tax payable from transfers that might be a direct skip or indirect skip here, and also net of any charitable deductions as well. So, looking at the big picture here, we have our unused GST exemption first allocated to direct skips that occur as a result of death, whether or not the property is included in the gross estate. So, we use Schedule R to report all of our GST exemption allocations. So if you remember nothing else today, remember if 706 is being filed for this purpose, you have to include Schedule R. If you don't include Schedule R, you're going to have these automatic allocation rules kick in. First, your GST exemption is going to be used to the extent of direct skips. So those can be broken down into a Part 2 and Part 3 of Schedule R. Part 2 is direct skips that bear GST tax, and Part 3 is direct skips that do not bear GST tax. So the big difference is that for Part 3, those are really like trusts that have express terms that say don't pay GST tax from the trust, but pay it from the estate. Those are transfers that have already happened during life, but to which the estate has to contribute additional GST tax because a direct skip occurs at the transferor's death. But most of the time, you're going to have direct skips reported on Part 2 of Schedule R. And in this case, if it's a direct skip from assets in the gross estate, the estate is going to pay that GST tax if the exemption is not sufficient in terms of allocation or intentional non-allocation to pay the GST tax due. If it's a trust that's included in the gross estate, whether funded during life or at death, for which there's a direct skip as a result of death, then the trust would contribute to that. And what happens, as we're going to see, is that the executor has to provide Schedule R1 to the trustee of that trust to report the trust's share of GST tax based on the final allocation of the decedent's GST exemption. So really what this statement provides, if it's provided to a trustee, is notice to the trustee that they have 9 months from the decedent's date of death, plus extensions, to pay the trust's share of GST tax on that direct skip after the exemption is allocated, if there's not enough exemption allocated to give it a zero inclusion ratio. Finally, we also have to look at 709 allocations too, because the executor has the ability not only for the final year of life to allocate GST exemption to gifts if not automatically allocated, but also to look back to transfers during years prior to the decedent's final year of life. The difference is going to be value. If you rely on automatic or manual allocation for a timely filed gift tax return, you get to use the date of gift value. However, if, for example, you have any transfers during life for which you've not allocated GST exemption, you can use a 709 to make a late allocation, but instead of using the date of gift value, you have to use the date of death value. So you might use this if, for example, you have non-exempt trusts created during the decedent's life, and maybe you want to go back and manually allocate GST exemption to those trusts using date of death values before allocating to testamentary trusts that are created by the decedent. Which brings us to indirect skips at death, because this is where there's some weird rules that aren't very clear, but really the spirit of these rules could be that you have a pool of property in which you allocate GST exemption ratably or proportionately, but that can include all trusts that have an inclusion ratio of greater than 0, whether or not funded during life or at death, and whether or not included in the gross estate. But in all cases, you're going to allocate GST exemption based on date of death values. And this is the automatic allocation rules, where we look at this pool of assets and allocate based on date of death values. And like we saw with lifetime automatic allocation, you can allocate automatically or manually based on GST potential. But in this case, instead of using the gift tax definition of GST potential, we look to whether, as of the date 9 months after the decedent's date of death, whether they could be a taxable termination or taxable distribution in the future. If so, that trust is going to be included in this automatic allocation. Now, in the big picture of those, we want to keep in mind that an estate tax inclusion period could be closed in full or in part at the decedent's death. And if the trust property is included in the gross estate, you have to use some intentionality to avoid automatic allocation to that transfer. So unless at the time of the ETIP funding you elected out of automatic allocation, you may have to go back through on the 706 and manually elect out. Otherwise, GST exemption is automatically allocated based on the fair market value of the property at the close of the ETIP. And then finally, we're going to get to separate share trusts a little bit more in the next part of this series, but separate share trusts and severances are not as simple as they seem at first glance. There are some really interesting and onerous rules that are really difficult to really grasp fully when it comes to the creation of separate shares of trust. We tend to take this for granted, especially using formula clauses to create, for example, credit shelter and marital trusts, but when it comes to the GST tax and the allocation of exemption, typically the GST rules look to the creation of one trust and the allocation of exemption to that one trust. And if that trust is then divided, then each share would keep the same inclusion ratio that applied to the master pre-division trust. However, there's a situation where any trusts that are created as a result of death, especially those included in the gross estate, may have a special window of time up to the filing of the 706 to allocate GST exemption to separate shares in a way that doesn't create the same inclusion ratio for each of them. Why? Mainly because if there's not enough exemption to go around for all trust transfers, it's more helpful if you can create a share that has an inclusion ratio of 0, which is an exempt share, and also another share possibly with an inclusion ratio of 1, which is a non-exempt share. And there's some special ways to get there, and we'll cover that more in the next part of this series. It may be 2 parts from now, actually, but really, when it comes to creating separate share trusts, you always start with the instructions under the will or trust instrument that divides the trust. A well-drafted will or trust should have GST language that tells you mainly how to create and fund each GST exempt or non-exempt share. And funding is important because that's a piece that's harped on in the regulations, because if the instrument is silent on the GST exemption allocation and separate share trusts and how you fund them, you end up having to go by default to the Treasury regulations, assuming that there was authority to create the separate shares. And The GST regulations say typically you have to fund each share on a fractional basis if you want to have separate inclusion ratios of 1 and 0 between each share. A lot of formulas may use a pecuniary basis, but this is more of an advanced subject. But there is a weird carve-out that says when you use a pecuniary funding formula, you may have to have statutory interest assigned to the pecuniary amount from date of death to the date of funding, which creates kind of its own separate rabbit hole that we're not going to look at today. But most well-drafted trusts should avoid this issue, but it's important to note that the fractional versus in-kind pecuniary types of funding mechanisms work differently here than they would with a traditional AB credit shelter marital trust type of formula. Which brings us to a final example today, which we're going to run through real quickly. We're going to assume that in 2012, the grantor transferred $6.4 million to a trust for descendants, and at the time, grantor had $5,120,000 of GST exemption, which was allocated in full to that trust. The trust was not divided into exempt and non-exempt shares at the time, which was its own issue. So as a result, that trust has an inclusion ratio of 0.2. Then at the grantor's death, that trust is worth $15 million. We're also going to assume the grantor's taxable estate is just $6.94 million, which will perfectly zero out their estate tax. So what that means is that the grantor has remaining applicable exclusion and GST exemption of $6.94 million after that 2012 gift. So the grantor is going to transfer the rest of their assets to 4 separate testamentary trusts of $1.735 million each for each of their 4 children, but we're going to ignore the division there and really look at this holistically as the testamentary trusts versus the lifetime trusts. So we're going to assume that 706 is filed because it's required to be, but the preparer fails to prepare Schedule R. So our pool of assets to which the exemption may be allocated includes the trust worth $15 million, which has a 0.2 inclusion ratio, and then the testamentary trust to be funded with $6.94 million. So really, when we look at that lifetime trust, it needs $3 million of GST exemption based on date of death values to bring it up to an inclusion ratio of 0 and make it fully exempt. And the testamentary trust would need $6.94 million of GST exemption to be fully exempt and have an inclusion ratio of 0. So we have $6.94 million of exemption really to allocate ratably among $9.94 million of transfers. So when we break that out, that means that both the lifetime trust and the testamentary trusts are going to have a proportionate amount of that GST exemption and aren't going to end up fully exempt or non-exempt. And that makes each trust partially non-exempt, which is a bad outcome. So what that'll mean is that down the road, especially for the lifetime trust, we may have to do a qualified severance to create an exempt and non-exempt share, and hopefully for the testamentary trust, rely on the grantor's estate planning documents to create and fund those exempt and non-exempt shares, assuming there's the right formula language in the trust document. So that's its own separate issue, but that kind of shows you an overall picture of the issue we have with the automatic allocation rules here. So closing out for today, even if no 706 is required to be filed, it's important to note that filing it does give you control over how GST exemption is allocated among direct skips and any other transfers that occur at death, whether or not the property is included in the gross estate. You still need to go back and look for lifetime void allocations to determine how much GST exemption is left first, and then consider whether there's any non-exempt lifetime trusts, and consider that automatic allocation under the 706 rules may allocate GST exemption to that trust if the 706 is not actually filed. So consider whether you should jump the gun and do a 709 to make a late allocation there, and also look for estate tax inclusion periods that are closed as a result of the decedent's death. And then go back, and if it's necessary, if you want to do a 706 to have some control over this process, you can do so, but keep in mind, Schedule R has to be filed to avoid these automatic allocation rules. And that's the schedule on which you allocate GST GST exemption among direct and indirect skips. And you have to take special care to, one, allocate proportionately on that Schedule R, and also look to each trust created under a will or trust instrument created by the decedent to determine how the GST exemption should be allocated and how separate shares should be created. And if you file a 706, even if it's not for this purpose, do not forget Schedule R. Ignoring that can create very bad outcomes for the decedent and the trust created under the estate plan. So what's coming next? We're getting close to the end of the basic instruction here, but qualified severances and separate share trusts are going to be a more difficult series potentially of parts, along with transferor shifts, but then we'll get more into a continuation, which may never end, of case studies on GST exemption on 709 and on 706 as a follow-up to today's part. No new terms were introduced today, but here's a glossary of your terms for review. But in the meantime, thank you for listening. If you have any questions or topic suggestions, you can send those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this presentation. I look forward to seeing you in my future content.